Welcome to the weekly update, where I'll go over the action in the market for the week of February 12th through the 16th, and then we'll see how things look for the week of February 20th through the 23rd. Monday's session will have no stocks or bonds trading. Will be closed in observance of President's Day, so the next trading day will be on Tuesday. I'm also posting the videos a little bit later because of the 3-day weekend, just to give myself a little extra time. Before I get into what happened this past week and where we're looking right now, just a few things to go through. There is a PDF that's available in the description, and I post this with every video. So if you want to download a PDF, whether it's a daily video, the weekly video, intermarket analysis video, some folks find that helpful. You can follow along with the slides. You can look at the charts. Sometimes it's a little easier to see things that way. Also, every day I update in the YouTube community tab the pivot points, and there are pivot points that last for the whole month, and I update that every day with the bar for the previous day. The ones that I pay most attention to on a day in and day out basis are the intraday pivot points, and those are recalculated for each day depending on what happened the day before. And this can often be a really good source of finding support or resistance for any given day. So please know that they're updated each day and they're available in the YouTube community tab. Also, I do have a private Facebook group. Not an awful lot of action going on there. I post whenever I upload a video, and that's about all that's really happening right now. That's kind of an idea that I had that never really took off and led to much of anything consistently anyway. I will be posting a new poll. I'll go over the most recent poll here in just a few minutes, and then I'll be posting some new questions to ponder. And then I keep a real close tab on YouTube comments. If it's garbage, if it's crap, if it's a spam comment, if it's somebody trying to contact me to sell me something, those are gone right away. And I give an email address at the end of each video. And if the people say, "Oh, I love your content. Oh, it's wonderful. Oh, come and sign up with this service that I want to sell you." If they actually watch the video like they said they would be able to contact me by email. But since they contact me by comments, I wipe those out completely. I want to keep that as an open spot for you to interject your thoughts. Maybe you like what I'm doing. Maybe you disagree with some of the things and some of the conclusions that I've reached. That's fine. We can have a back and forth. I just want it to be a good, honest back and forth discussion. I don't get a lot of comments, and you'll find my videos are different than a lot of other folks out there because I'm not telling you my opinions. And I know that the stock market, anything in life can be very polarizing, whether you agree or disagree. My whole approach to this is I let the charts tell us what's going on. And because of that, there's not an awful lot to argue with. There's not a lot to disagree with. You may say, "Well, I don't like how you interpreted this chart." That's fine. That is just fine. So anyway, it's there. It's available. If you want to keep it a little bit more private and just have some interaction with me on a one-on-one basis, there is an email address there, and you can always send me an email and we can discuss things that way. And then I do post videos not only on YouTube, but on Rumble as well. Sometimes I have some problems on either one of the platforms. And here's the link. It's also in the description below this video. Let's go back and talk about what happened. For the week, we were down. This is the first down week that we've had in a while. Not by very much, but we still had a down week nonetheless. We were down 0.42%, and volume was above average, but for most of the week, we were under the average levels. It was really Tuesday's session. CPI came out, it spooked the market, it was stronger than expected. The market really went down, and we saw volume really pick up on that day. We spent Wednesday and Thursday clawing our way back, but the bounce back up was on below average volume. So, and then in the upcoming week, we'll be below average volume because there'll be 4 days throughout the week instead of 5. The technicals, we're still looking positive. We have some things to always be concerned about. We're coming into a period of what historically has been weak seasonality. And that's about the middle part or so of February, going into, depending on how you interpret it, to the latter part of February. Some charts that we look at even take us into the middle and even latter part of March. We have been really overextended to the upside. We're starting to see some economic reports come in that are stronger than expected. A lot of folks have been really riding this wave higher, and they may be starting to look into taking some profits and locking those in. And so we may not see this. The market may still continue to go up, but if we do see a period of weakness, we'll be watching that. And I allow this to unfold every day in the daily videos, and we just kind of watch the story be completed day by day by day. These videos are meant to look at a little bigger picture of what's actually happening in the market, and it all comes down to inflation and interest rates. Interest rates have been going back up, and that's been pressuring stocks. There's also this idea that the Fed is probably done raising interest rates, and that at some point in 2024, they're going to lower interest rates. And now the big debate and the game goes back and forth as to when that will actually happen. If we get economic reports that are pretty strong, that has a tendency to pressure the markets. If it comes in more market friendly, the markets tend to like that. And that's just what happens day in and day out. Naturally, there are a lot of geopolitical things happening right now, but the market just isn't really paying attention to that. But that could change at any time. Some kind of an event, whether it's in the US or somewhere around the globe, it may not last very long, but it could come in and actually have an impact on what happens with stock prices. And then Fed speak. We're going to get the FOMC meeting minutes that will be coming out in Wednesday's session about 2 p.m. Eastern time. And the market's going to dissect that and try to find any secret meaning in those meeting minutes. And the market could react to that as well as some of the Fed members actually giving interviews or speaking in the financial media or writing an article or what have you. Our trend is still strong in the fact that the ADX is above the moving average and the moving average is above 20 on the weekly chart. We're still positive. Even with the down week, the green line is coming down, but the green line is still on top. So we would default to positive there. So for the week, the Dow ended up being down 0.1%. The NASDAQ was down 1.3%. The S&P was down 0.4%. And believe it or not, and we've been waiting a while for this, the Russell 2000 small caps, they were up 1.1%. So we had a mixed week when we take all of this together. So it was a mixed week. The S&P ended up declining, or the broader market ended up outperforming. The mid caps had an okay week as well. Tuesday saw a broad, sharp decline when the CPI came out. That took the market by surprise, and the market reacted to that in a negative way. And there's still this hope that inflation will continue to be more market friendly and that the macro environment, the big picture, will remain strong. That's kind of like wanting the best of all worlds at the same time. We don't want inflation to be a problem, but we want to see growth all over. And at some point, those get out of balance with each other. And that the idea that the Fed will cut rates sooner rather than later, that's the market always wants that. Then retail sales came out in Thursday session, and they were weaker than expected. And that's like, wait a minute, this is a huge part of the U.S. economy, and people aren't out buying stuff. And then weekly jobless claims, though, they came out, and that's kind of our most recent look at the employment situation. And this actually showed where jobless claims went down. So the employment situation is still looking strong. Also, PPI came in stronger than expected. So in some areas, the market's it's a little confused right now because the economy is looking strong in some areas. And then when we look at retail sales, it's weaker in other areas. Interest rates and the dollar were up on the week, and we ended up closing at 4.3% for the 10-year yield. Stocks, we've been dealing with an overbought condition for pretty much all of 2024. And the fact that at some point there's going to be, at minimum, some kind of a pullback, it would not necessarily be surprising because folks want to lock in these profits. What we'll be watching if a pullback does start to develop, is this turning into something more negative, or is this just a common retracement before the market then gets set to go higher? The markets will be closed on Monday in observance of President's Day. This is a chart that I've been showing for 6 or 8 months now. This is just showing the blue line is what happened with inflation from 1966 up to 1982. And we were matching that along, going up about halfway through 2023. And we still are kind of in this period of time where we see inflation decreasing overall. The reason why I keep showing this chart is look at what happens after that. We see a real turn up of inflation. Now, we don't know if that's going to be what happens this time, but it happened back in the 60s and 70s and led to hyperinflation going into the late 70s and didn't finally get under control until we got into the 80s. Is something like that going to develop? We don't know. We just want to be aware of this. Then looking at the RenMac research, we closed at 4.3% for the 10-year yield. That's above the 4.02%. This is when interest rates can start biting into corporate profits. Here's the poll results. The first question, and I've tried to reword these just a little bit. And if you have any feedback on maybe a question that you want me to ask or the way that I ask it, please feel free to do that. These are really for you, just kind of express how you feel about things. So a week ago, I asked, stocks will be entering a period of historical seasonal weakness, and we're just kind of coming into that right now as well. We're about in that middle part of February. Do you feel that we will follow this pattern by declining? 71% said yes, 29% said no. I'll probably ask a very similar question now that we're getting a little deeper into this possible historical weakness time. All time frames in the S&P 500 are overbought, and that means the short term, intermediate term, long term, and then on the weekly charts, we have a lot of overextended to the upside conditions. Does this concern you? 67% said no, because in a solid environment, when we're looking stronger and more positive in the bigger picture, we can stay overbought for quite a while. If you notice back in 2022, we would go right up to like the 200-day moving average and then hit that and turn and go down. Well, we were in a cyclical bear market at that time where overall we had been declining. And so we don't tend to stay in real overbought conditions during that time. But we're now back in more of a full-fledged bull market. And so we can ride this wave and be overextended to the upside for quite a while. Then interest rates continue to rise. Does this concern you? Yes, 70%, no, 30%, and they're still going up. And I kind of updated a few charts here that I'll show you here and then in the intermarket analysis video as well. The S&P closed above 5,000 for the first time on Friday. Now, this was a week ago, and we're still above 5,000 for right now. However, volume decreased as this happened. Does this concern you? 67% said yes. That does concern them. 33% said no. That's one of the technical analysis textbook warning signs, is when you see a stock or a sector or an index moving higher, especially hitting an all-time high and crossing over a brand new threshold like 5,000, and you see volume tapering off. That's one of the warning signs. Doesn't mean it's going to turn on a dime and go the other way. It just means that there's not an awful lot of conviction behind it. All right, here's some Isabel Net charts. These are usually the ones that I show. This is, again, just updated to tell you that looking forward, we're still looking positive as far as earnings projections going forward. And then according to Goldman Sachs, we expect the S&P 500 to rise by 5,200 by year end. Okay, we're right around the 5,000 level now. When they did this chart, we were at 5,006, and that's just what they're expecting. But you have to kind of take some of these charts with a grain of salt. If we were going down, their projection would be lower. If we're going up, their projection is going to be higher. So, they're people with emotions just like everybody else. We are still looking a little extreme when it comes to sentiment. We're coming above this dashed line here, which just means that folks are getting pretty optimistic. And then we have new privately owned housing units that are authorized and permit issuing places. Okay, why can't they just speak English when they do these charts? But what they're noticing here is other times when we spiked out and started to come down, a lot of times that happened right before a recession. We did spike up here and we're starting to come back down. Could this suggest that we're going to go into a recession? And that's part of the big debate right now. You have charts that you can look at that totally justify the idea that we're going to go into a recession. There's other charts that you can look at that suggest, no, we're not really seeing any signs of recession. And the debate goes back and forth, and everybody thinks they're right. Where I try to look at everything I can and just say, okay, this is one scenario that may play out if we do end up going in that direction. Okay, that's how things go. But for right now, you can make a case for either side. All right, and then this is the earnings per share estimates going forward for the year-over-year growth. We're this area that's a little different color. That's what we've already been seeing, and the consensus right now is that we'll see 7% earnings growth. These blue areas going forward, that's projecting out what hasn't happened yet. I guess the takeaway from this is we might see a little bit of a decline in the first quarter when those earnings start to come out, but they are positive. We're not seeing this really tapering off. Then here, this is earnings breadth, and I showed this in the video it was either for Friday or for Tuesday, where these are just revisions. And when we're below this zero level, that means they're revising things down. And so we are negative, but we are starting to come back up as we're seeing a little bit of an improvement with the earnings revisions, even though it's still negative. Here's some FactSet updates right here. The S&P forward PE ratio rises to 20 for the first time in 2 years. And that's what we look at in the intermarket analysis video. And we are above 20 when we're looking forward. Remember, with PE ratios, we have that 10, 15, 20 scale. 10 or below is inexpensive. Between 11 and 19, the market is considered Goldilocks or fairly priced. When we get to 20 or above, that's when the market is considered to be expensive. We look not only at historical values, but we also project forward because that's what the market does. And all they're saying right here is that we're starting to get expensive when we're looking out, even based on future projections. Then here's the update. As of the time that this was posted on Friday, 79% of the S&P 500 companies have reported. 75% of those companies that have reported are above their estimates. And when you take them all together, their earnings are 3.9% above estimates. And again, this is taking all 500 companies or 505 companies together, so it might be skewed just a little bit. But earnings season so far has been going fairly well. All right, then getting into our intraday chart, we go all the way back to Monday, where this is where really when we set the high for the week, where we had a higher open and then ended up coming down off of that. Then we had the CPI come out on Tuesday, and that's when we really gapped lower, and that was a pretty significant downward move. The one thing that was positive is later in the day, we did see some buying coming back in and repair a lot of the losses. We did see some late day buying coming in on Wednesday. We also had a pretty good day on Thursday, but then we ended up being down on Friday after PPI came out. So we closed off of the high for the week. So looking at just the 5 trading days for the past week, we had the NYSE that was up, and all of the other indexes ended up being down. This is not Friday to Friday. This is just Monday through Friday to give you a little bit different perspective. Going back to the beginning of the year, all of the indexes are up except for the small caps. They had turned positive earlier in the week, but now they've dropped back down to being negative since the beginning of the year. Our different sectors, and I have 2 charts to show you. Since we had a down week, this is organized from showing what was down the most, communication, and then real estate, where communication has been one of the stronger areas. And then some of the areas that were a little bit better, these tend to be more defensive, staples, healthcare, and materials. They ended up being up on the week. So I organized this according to the percentage change over the last week. Then this next chart looks at the scooter score. This is how are they performing within the context of the market, where we still have communication looking the best, followed by tech, the financial sector, which is holding up, even though we're keeping an eye on New York Community Bank, industrials, healthcare, and discretionary. These are all looking more positive. The one area that's been really weak lately has been utilities. And then here's our relative rotation graph. And we're seeing real estate starting to make a bit of a comeback here. The financial sector, it's also green. We saw a bit of a pullback in tech, and it's showing some improvement, but the XLC, that's communication. And tech and communication have been some of the stronger areas, but lately they haven't been quite as strong. Way over here on the left-hand side, we have energy, which was a really good performer in 2022, and since then has been really pulling back and is one of the weaker areas. Then looking at all the different sectors just for the 5 trading days, where we had tech, communication, those are the stronger areas, but there was some profit taking overall in those different sectors. Going back to the beginning of the year, we have communication and tech being positive. All of the other sectors are now negative. Keeping an eye on sentiment, we're above that 75 level. We came in with a reading on Friday of 77. To get better context here, we've been chopping around here. And you'll see that when we're in a more positive environment, sentiment is going to stay up in the higher areas. When we're really going down, that's when it goes down into the lower areas. And so we came up above 75, fell back, came up above 75, fell back. Now we're back above 75 again. The active asset managers, they're also starting to get extreme positive. And when they do get extreme, even though these are professional money managers, they're human beings. And we tend to use this as a contrarian indicator when they're giving us some kind of an extreme reading. They've been looking pretty extreme positive lately. So it doesn't mean everything's going to turn on a dime and go the other way. It just means that, okay, folks are getting a little too giddy about things. And so we might look at some kind of a pullback. Then here's another look at that same number where we came in at 95.58. We're above the 90 level. We did get up above 100. This still could go higher than where it's at right now. Then this is put out by Real Investment Advice. This tries to track what we just looked at, the active asset managers. Those are the things here in red. And then we put the S&P 500 on top of that to see how the market ended up reacting. You may just want to pause and look at this. Some folks find this to be a helpful chart. Other folks are like, there's so many lines here, I can't figure out what's going on. All right, when we look at the VIX, this is our fear gauge that we look at. We did go up with the line chart, and we've been seeing this start to increase as the market's been under a bit of pressure lately. Excuse me there. And when we look at the bar chart, we're going back up, but we still have been getting really low readings with the VIX overall. The Ulcer Index is also giving us a very low reading. So this is lining up more with what we're seeing with the VIX and with our other sentiment gauges to suggest that there's not a lot of fear in the market. Here's the RIDEX Bear Bull ratio. We also show that fear is decreasing with this ratio as well. And here's another sentiment look with the latest reading of the American Association of Individual Investors. They're not extreme positive right now. They were near the end of 2023, but now they've been coming down. That's one way to look at this. They're not getting extreme at the current time. We also look at this red line, which is a moving average of how they've been feeling, and we crossed above 0. Now, until it gets to an extreme reading, which may not match some of these other high levels, we can kind of go with this. So it's just when they really start to get over exuberant, that's when we start to look at using this as a contrarian indicator. Also, the latest reading from Investors Intelligence, we are above 3. Now, we can go higher than that, but typically when we get above 3, this is the warning area suggesting that folks are getting a little too happy about the market. We're also comparing cash and comparing it with the tech sector. The black line continues to go down, and that's positive for tech. Keeping an eye on some different economic news or reports here. This is the latest reading of GDP now. That's the green line where it has it just under 3% with GDP. When you look at the forecast, we're at about 2.5% to the upside and about 0.75% to the downside. Here's what it looks like on a bar chart. The takeaway from this is that you notice all the bars are above 0 because a definition of a recession is when we have 2 quarters back-to-back of negative GDP. Then here's another look at GDP put out by Goldman Sachs, where we're starting to look ahead now. What's it going to be for the first quarter in 2024? They're a little more optimistic at 2.9%, where this black diamond in here, that's more the consensus. That's what the other economists are thinking. The takeaway from this is even though we're seeing this declining, even when you look at Goldman Sachs, we're seeing the consensus actually going back up, but they're positive. And that's kind of because this is going to get shifted around and it'll be adjusted 100 times. Then we look at the spread between risky and not as risky bonds. And when this is going down, that means that things are okay. It's when it really spikes up. That's when we are worried about what's happening economically. The Chicago national financial conditions continue to be below the black line and declining. That's positive. We get nervous when it goes above the black line. The bank tightening standards have been decreasing. We had this reading a week ago, and it shows that banks are a little more willing to loan out some money. And we had the latest reading from the real-time SOM recession rule indicator. We're below the red line, and that was updated February 2nd. Also, we're just barely above the black line with the U.S. recession probabilities. We get concerned when we go above the red line. We're coming down a little bit here with the Brave Butters. That was updated at the end of January. Keeping an eye on inflation, where this is adjusting now that we had CPI coming out and then PPI coming out. So you're seeing a little gyration here. We're not getting any major inflation reports in the upcoming week. We'll probably get PCE the week after that. Keeping an eye on the Fed. They pretty much have taken this idea off the table that the Fed's going to raise that the Fed is going to lower rates at the March meeting. There's now a 90% chance that rates are going to stay the same. They're currently at 5.25 to 5.5, and that's where they think they will be after that meeting. We can see how this has changed where not a lot of folks were really thinking this. Well, this is right now, day ago, week ago, month ago. We've come more into that camp thinking, all right, we're taking March off the table. Now they're going to look ahead to May. This is what it's looking like right now. They still have a 61.6% chance that they're going to leave rates the same, but we're starting to see a little more folks think that there could be a rate cut at the May meeting. And this is also showing us how that's changing, where it was looking a little more like they were going to keep rates unchanged. Then that seemed to be the camp that everybody was in. Then it looked like, well, maybe they're going to cut rates, but now even that's falling off a little bit as we're getting CPI and PPI coming out stronger than expected. Then the Fed balance sheet continues to decline, and it's been doing that since June of 2022. This shows you the year-over-year change. Even though this is going up, we still see a minus sign when we're looking at the total assets when you take out the liabilities. Here is breadth. We're still looking pretty good here. We're above an advancing moving average when we look at the price. We're also advancing when we look at volume. You could see a little bit of a negative divergence here where price is breaking out above these previous highs. We have not broken out above these previous highs based on volume. And we are seeing volume lagging just a little bit when we look at the daily charts, and that's somewhat of a concern. Then we look at the new highs, new lows studies where we're coming down with the 4-week and the 10-week average, even though the new highs are really outpacing any of the new lows that are being generated. And we're still looking fairly healthy on the daily chart with that. We declined with the down week, but we're still above zero with the advanced decline ratio, and we're still looking good there on the daily chart. This is a smart money indicator, accumulation distribution. We're still above an advancing moving average, and that's looking good on the daily chart as well. Here's our trend. We have the ADX above the moving average. That suggests that the trend is getting stronger. It's also suggesting that we're in a trending environment because we're above 20. We default to positive because the green line's on top, even though it declined with the down week. We look at the Arun indicator. We're above zero and advancing. The green line is on top. That means there's more buyers. The red line is coming down. That means there's a decrease in sellers. And the difference between the two is how the oscillator is calculated. The mass index is not generating a signal. Here's our daily chart, and I have this trend line that I drew in here. So far, this has been acting as pretty good support. If we start to pull back and drop below this trend line, that's when we're going to get concerned. If you look at the bottom, you see where other than in Tuesday's session, we've been below average when it comes to volume. And no changes with the decision point scorecard here. And I have another new one that I started including in the daily video. This is put out by David Keller, who's associated with stockcharts.com. He has his own short, intermediate, and long-term model based on the S&P, mid caps, small caps, and the NASDAQ 100. And right now, everything is pointing up. Here's our trend channel. This is also suggesting that we're positive. We continue to go up. We're in the upper end of the trend channel going back to 2009. So this is still showing longer term we are positive. This is another area, if we do go up, I want you to be aware of here. This is the R1 overhead. It's about at 5110, maybe 5111. If we still go up with the S&P from here, the reason I bring that up is right at the end of 2021, we hit one of these weekly pivot points. Actually, this is a monthly pivot point, and that's where we topped out, and then things went crazy in 2022. Then we started to bounce back up. In July of 2023, we hit another one of these longer-term pivot points, and then we spent the next few months going down. We've been able to get above this pivot point. We haven't reached this point, and we may not even get there. But if we do continue to go up, keep an eye on this level, about 5110, 5111. If we hit that, see if that ends up acting as overhead resistance. Then, looking at the trend with a 50-period simple moving average, price is above the red line and both are going up. That's positive. When we do our crossover, we're also looking positive with the S&P. We're coming right back up to about the midpoint with the McClellan oscillator. So that's showing a little bit of an improvement there. We're coming down with the summation index based on price after being extreme. We're still above zero when we look at this based on volume. We're above zero with the Swenlin trading oscillator based on price and volume. So this is still hanging in there positive. And we're seeing pretty much the same thing in the daily chart. We came up to 70 right at the end of 2023 with the bullish percent index. We've been coming down, and we're trying to show some improvement here. But when this drops below 70, technically that is a sell signal. So we would look for this to continue to decline. Now, if we turn and the context starts to go back up, then we would switch back to being more positive. Looking at the PMO, or we're still going up on a momentum basis when we look at our weekly charts, even though we're declining based on price, we ticked up a little bit based on volume, but these are still positive since they're both above zero. Looking at our PMO studies, showing an improvement with the PMOs that are rising, the buy signals are improving, and now we're declining after being extreme positive with the PMOs that are above zero there. The percent B and looking at the Bollinger Bands, we never did get outside of the upper Bollinger Bands. This is positive because we're above the midpoint and the midpoint's going up and we're not getting an extreme reading. The percent B measures when we're above or below one of the upper or lower Bollinger Bands. Here's our momentum. We're still looking positive here. We're seeing a bit of a mixed picture, but an extreme positive picture on the daily charts where the slope and the TSI are positive, and now these are looking extreme positive. You can see really high readings here. More intermediate term with the MACD, the PMO, and the PPO. These are still positive for right now where they're rolling over a bit on the daily charts, and the TRIX and the KST are also looking extreme positive. And what we're starting to see on some daily charts are negative divergences. We're not really seeing those here on the weekly chart, where it comes up and makes a high, and then we start going back up and it makes a lower high. That's a negative divergence. That's part of that has to do with how the indicator is calculated. We're not really seeing that when we look at these indicators here. The chicken money flow is another smart money indicator. That still shows that the smart money is in buying. The chicken oscillator is looking extreme positive. This is another one of the smart money indicators. The force index declined, but it's still above zero, so it's green. That's positive. We're coming down after being extreme positive with the money flow index. And since we had the down week, based on this week versus a week ago, we're down a little bit with the rate of change. Going back 50 weeks, we came down, and you could suggest that we're getting extreme positive, even though we can go higher than where we've gone so far with this. The RSI based on 14 weeks is still extreme positive and starting to come down. The weekly special K chart is going back up, but we're still below the red line, where the daily chart is still positive. The Stochk RSI is coming down, but still extreme positive. The Williams percent are also extreme positive and coming down. We're looking extreme positive with the ultimate oscillator, and we're coming down, but still looking extreme with the vortex. The copy curve rolling over a bit, but it's still above the moving average. That's still positive. You might make some kind of a case that we're getting into an extreme reading with the indicator. We're not really seeing anything here. These are longer terms. This is a 200-week moving average, and we have our other fib lines. As long as we stay above all these lines, these would end up being support if we really start to decline. We're bouncing around a little bit with our 253 period equity put call ratio. And when this goes down, that tends to be positive. When it goes up, that's more negative. And it's still trying to figure out what it wants to do. Also, we're going back up with our VIX and then our 3-month average of the VIX. It's more positive when it's coming down. The fact that it continues to go up is a warning sign. And then looking at our weekly versions of the Heiken Ashi, we continue to be positive there. We're positive with the Kegi chart since we're pointing up with a black bar. We're positive with the Renko chart, and we're positive with the 3-line break. We came down just a little bit with the ease of movement, but we're still above zero that way. And we didn't have anything new drawn here in the point and figure chart. We're still looking positive here, setting recent all-time highs. The last signal that was generated was a double top breakout back on November 20th of 2023. Looking at our longer term momentum here, we're looking okay with the long term with the PPO. We're coming down a little bit in the intermediate term, and we're seeing this come down, but still positive in the short term. We switched over to neutral with the Elder's Impulse system after we spent a number of weeks looking positive here for the S&P. And we did switch over to negative on the daily chart with the parabolic SAR. We have the dots on top, but still we are positive here with the dots underneath. And then here's some daily charts. I've been watching growth versus value, and we had been showing a real improvement there. Well, this week we're seeing this trailing off. We want to see, is this going to continue and keep going down? Are we going to turn and go back up? To be more positive on the market, we want to see this ratio going back up. Also, we did see some improvement here with small cap growth to value, where we're shooting out. Now, we came down in Friday's session, but this is breaking out of the range that it had been in for almost a year. We're also seeing some improvement, even though it came down in Friday's session, with the mid-cap growth to value. And we're also showing some improvement with S&P growth to value, even though it did pull back recently. And we're also seeing a little bit of an improvement here when we compare discretionary to staples. We had been seeing a negative divergence. We started to break out, even though we're seeing some weakness right now. If this can keep going up, that would be more positive for the market. Now, another thing, and I'm doing this mainly out of a warning sign, just to let you know, there are folks out there that are, no matter what happens in the market, things are going to fall apart. It's right around the corner. The next disaster is on the way. And I don't know why they do this. One of the things that they use to justify their negative positions, and I call them perma bears, is they use a thing called the Hindenburg Omen. And there are some folks who tend to be quite negative on the market overall, and they just love this thing. And so if you pay attention to any of them, they're just going to be harping at you on this, and they're going to be presenting this to you as though this is a fact, that this is a warning sign, that you need to be all freaked out and concerned. And they could be right, but they're also wrong an awful lot here. And what I did is, over on the left-hand side, this is a definition of a thing called the Hindenburg Omen. And it was the Hindenburg that crashed in 1937. Oh, the humanity. And so since it was such a disaster, that's how they came up with the name for this. And I did some research after this came out, and I wasn't really all that impressed. And then I went to Investopedia, and their research kind of mimicked what I found out, that there's really only a 25% success rate with the Hindenburg Omen. Okay, that's not good enough for me. And so that's why I don't have any charts to show you. That's not why I'm really harping on this. But it does mean that it's right 25% of the time. Okay, even in baseball, if you can hit between 250 and 300, you can make millions of dollars a year. That means you're going to fail 6 to 6.5 times, or 6.5 to 7 times out of 10. Would you go to a doctor that did that? Or would you fly in an airplane? Yeah, I have a 300% chance of actually landing the plane safely. Anyway, this isn't good enough. We have better tools than this, in my opinion. Now, you may disagree, and that's fine. But what they concluded in Investopedia is the conclusion that I've reached is that, okay, it may not always be correct, but we should probably use this in conjunction with other charts. And that's kind of another thing that I'm big on. A lot of the perma bears, especially, they'll show you one chart, one small piece of the overall puzzle, and then develop a big picture scenario based on that chart. When no, you need to have more context of what's going on. And that's why I don't use this all by itself. There's another chart later on that I'm going to show you where another perma bear is, he's like set up the entire big picture scenario that we're just going to tank based on one chart. And I don't like to do things that way. That really can lead people astray for doing things like that. All right. This, in fact, no, this isn't the chart. This isn't. What I started to do is I drew a trend line going from the October low and then connecting these previous lows. Right now, we're above this trend line. So we're okay. Now, if we do start to pull back and we actually come below and then close below this trend line, right underneath this, you don't see it here, but we have the 20-period moving average, and that's could be another level of support that we may hit if we start to decline. Then this isn't telling us anything right now. I have a new Fib chart based on Fibonacci retracements. This goes from the October low to the all-time high. And if we do start to go down, these are the current retracement levels. Of course, if we go back and set another high, this will have to be adjusted. And another thing we're watching is a correlation between the VIX and the S&P. We're getting a pretty high reading, and we've been getting it. We came up, got a reading, came down, went back up. And quite often, if you look at when we had high readings and these red lines, and then what the S&P did after that, it could be short to intermediate term negative. Okay, we're getting a high reading right now after getting a few readings along the way here. And then we're also watching the skew index. This doesn't necessarily mean it's positive or negative. This is mainly focusing on the idea that the market is expecting some kind of a move. We're up in this red area, we came down. We're back up in this red area, and we're just at the lower end, or just coming out of the red area right now. So as of Friday's session, the market is just coming off the idea of seeing a big move. Has it already happened? Well, we closed down just fractionally in Friday's session. Is it going to happen going forward? That would be my guess right now. Is it going to be positive or negative? Well, we're coming into some weak seasonality. We're in an overbought situation. Sentiment is extreme positive. You might want to default to the downside, but see that followed through based on price. Price is the ultimate oscillator. And until we really start to decline based on price, the jury's still out on that, at least with the way that I analyze things. Also, we are seeing a longer-term negative divergence. This is a study in the top area of the S&P 500 stocks that are above their 200-day moving average. Down below, it's those stocks above their 50-day moving average. And we've been going up with the S&P. This has been trailing off. That's a negative divergence, both above and below. So that's another warning sign. And then we are seeing a longer-term negative divergence with the Dow and comparing it to the transports, where we're just recently setting all-time highs with the Dow. We're actually going down with the transports. Now, I was watching some stuff and looking at some different charts, and in other areas of the market, like railroads and airlines, some of them are showing some improvement, but we're just not seeing it coming through to the transport index itself. Now, there are other transport indexes. There's one for the NASDAQ. There's one for the S&P. I'm following the traditional Dow transports right now. So you might be able to find some exceptions to the conclusion that I'm reaching here. But nonetheless, this should be going up and ultimately confirming the all-time highs that we're seeing with the Dow. And we're not seeing that yet. Then we are in the month of February, where we tend to be down for the month overall, and we're up about 40% of the time from 2020 through 2024. This is just a plain vanilla look at all the different indexes where we're coming off of recent all-time highs with the S&P. We've not set an all-time high, but showing a little bit of an improvement with the mid caps. We have a further ways to go here with the small caps. So when you take this all together, this is not confirming each other. We're not seeing it be confirmed by the mid caps and small caps, at least yet. The Dow, though, is still in an overall uptrend and coming off of setting recent all-time highs. The NASDAQ is still in an uptrend. The NASDAQ 100 is in a solid uptrend. This is a weekly chart of the QQQs. We had a down week, but we're coming off of recent all-time highs. The mid caps are in an uptrend, but not breaking out yet. The small caps are also in an uptrend, but not coming back to previous highs yet. The NYSE, a broader measure, we're coming back and getting really close to setting a new all-time high there. All stocks are in an uptrend and setting all-time highs. The biggest software companies are also in an uptrend. The FANG index didn't set an all-time high this past week, but is really close to it and is in an uptrend. ARC still in an overall uptrend, and it was up about 1.5% on the week. We're keeping an eye on the banks. This is the bank index. We're also watching the regional bank ETF, where we're seeing a little bit of weakness here based on price, but we're still hanging in there when we look at the RSI as well as the momentum, even though this is rolling over slightly. Looking at the deposits, we see here that there's a minus sign, so we're seeing more money going out of banks than is going into banks, even though this line has been going back up. And then here's Dow theory with a weekly chart, again showing how we're hitting all-time highs with the Dow recently. We still have a ways to go looking at the transports, and the utilities are under some pressure. Then here's the CRB index, which is in a downtrend and has been chopping sideways recently. These are the commodities. Oil has been chopping around kind of in the 70 range recently. Copper is kind of chopping more or less sideways as it tries to figure out, are we looking better with the economy or are we looking worse with the economy? The dollar has been rebounding since the beginning of 2024, even though it's still in a longer-term downtrend. Gold, just about the time everybody is sure it's going to the moon, well, it ends up retracing, even though it's still in a longer-term uptrend. We're chopping around the moving averages here with silver, but we're still below the moving averages together. Keeping an eye on interest rates, we are still in an uptrend when we look at the total bond ETF, even though interest rates have been going up, so bond prices have been going down. This is a monthly chart showing how stocks continue to outperform bonds. Sorry, I have to keep clearing my throat here. This is the 1-month yield and subtracting the 3-month yield. We should always get a negative result. For the last number of months, we've been getting a positive result. Not sure if that's a warning sign, but it's been going on now for quite some time. Here is the daily chart of the different yields, where from the October lows that we set in the stock market, we were declining with interest rates. Then we're going pretty much sideways. Now we're starting to see interest rates going back up. Here's a weekly chart looking internationally with the US, UK, and German rates all going up, and we saw a bit of an increase with the Japanese rates. This is just a historical chart, and this really goes back to October when we hit the 5% level with the 10-year yield, and then we started coming down. And I've been showing this because you look at other times when we spiked, did that mean something terrible was going to happen after that? Well, sometimes yes. But there's other times when we spike and nothing terrible happened. It's a spike that's not circled here. Just something to be aware of with this. Also, we're looking at real rates, which means we're taking inflation into account. This is when bubbles pop. And this is when we had the downgrade of the U.S. debt, at least a warning sign here. And that's when we hit a top here, and then we started to go down with this. Then some relative studies. We start off by looking at an intermarket analysis chart going back to the beginning of 2024. Oil is now in the lead, followed by stocks, and then the dollar, where gold and the price of bonds are negative. The NASDAQ 100 to S&P 500 ratio is still looking really solid, with the NASDAQ 100 outperforming. The S&P 100 continues to outperform the S&P 500. Growth is still outperforming value, and gold is underperforming when we compare it to the S&P. Gold is also underperforming when we compare it to the dollar. As the dollar's been going up and gold's been under some pressure, we're seeing this ratio going down. Bonds continue to underperform stocks on a little shorter term basis. The low volatility to S&P 500 ratio continues to decline. And discretionary is still outperforming staples. We would like to see discretionary show some more sustained upward movement than what it's been showing lately. And energy has been underperforming the tech sector. Then we look at our longer term cyclical and secular trends where we are positive when we look at the NYSE Brent Thrust. That was a signal generated in October 2022, and this is indefinitely on the books. Then over the last year, we had two ZWAG NYSE Brent Thrusts that were signaled, and this is also indefinitely on the books, and this is a positive signal. The Zohar chart continues to be working off of a buy signal. And here's a chart going back to the 1987 crash. We're still above this longer term trend line. Here's a shorter blown up version of that same chart where we continue to be above this trend line. And then we're looking at the new highs minus the new lows on the NYSE and then comparing it to the S&P. When we're above zero and advancing, that's also suggesting things are positive. And then we look at just the S&P, the 50-period exponential moving average. This is also continuing to go up, and that is positive as well. And then we have the NASDAQ 100 weekly chart going back to 2009. We are still above this. Now, if we really start to kick into gear and head lower, we're going to be watching these trend lines. This is the other chart that the perma bears like to point out. And they could be right, but we've been listening to their warnings for decades now as things keep going up and up and up. Okay, this is a ratio between the NASDAQ 100 and the Dow. The NASDAQ 100 is tech. The Dow is more your established blue chip companies, they're not necessarily growth per se, they're more value, and they've stood more the test of time. Well, when we saw this ratio really going up, that was the dot-com boom. And then we topped out and we saw the dot-com bust. Then we spent a number of years, 14 years, 18 years trying to come back and recapturing what was lost. And then we hit this same level right at the end of 2021. And that's when the market topped out. Then we went into 2022 and we saw this really going down. Then we hit the bottom in October of 2022. Now we've been going back up and we're getting really close to this ratio again. Is this marking the end of the stock market world as we know it? Maybe. But there's also a lot of other positive things going on. We may break above this and set a new high with the ratio. But again, the perma bears are going to present this to you that this is a done fact. There ain't no arguing with this. And this is just the way things are going to be. And they could be right. But at the same time, they could be wrong as well. So we want to keep an eye on this. We want to respect it. And if we do start to see a decline here, we'll just be evaluating things day in and day out to see if things are switching back more negative. Here's another similar study with the QQQs, which is the NASDAQ 100, and comparing it to the IWM, which is the Russell 2000 small caps. We're also coming off of a recent high reading here. Again, you could, end of the world, baby. Okay, or, all right, we just watch this. We know about it. If things start to develop, we will react to that. Then we're looking, it's still in an improvement here when we take the NASDAQ cumulative new highs, new lows. It's starting to turn back up and it's staying up after it had been declining for many years. And then we're also keeping an eye on this, wondering if it's a warning sign or not. This is the 3-month yield. We topped out back in 2007, then everything went crazy. And as we were going through the great financial crisis, they kept lowering and lowering and lowering interest rates. Well, we're back up above that, and we've been up above it now for quite a while, and we're possibly topping out and coming back down, but interest rates have been going back up lately. If this continues to drop, we don't know, but this might be giving us some kind of a warning sign, but we don't want to take this in isolation. All right, then this is just for Tuesday's session. This is how things are looking right now. The markets will be closed on Monday in observance of President's Day. Our technicals are still positive on the daily charts, but we're still looking slightly overbought. We're wondering, is that weak seasonality going to start to come into the picture? Some of our charts suggest that it should already be here, but it really hasn't kicked into gear yet. We'll get the LEI, the leading economic index, in Tuesday's session, and then we're keeping an eye on the different geopolitical events to see if they have an impact. We do have a fairly light week when we're looking at the economic reports. The big one is probably going to be the FOMC meeting minutes that will be released on Wednesday. Seasonality, just for February 20th, we are negative across the board with the Dow, S&P, and NASDAQ. We're also going to be in the week after options expiration, which tends to be down more than up. This is a Carson chart showing that from the middle part of February going into the latter part of February, we tend to see some seasonal weakness. This is a longer term look where we do see some weakness that actually could carry over into the middle to latter part of March. And here's the Stock Traders Almanac, also showing some potential seasonal weakness. This is when the sitting president is running for re-election. We think that's what's going to happen. And that's the green line where even in a good year, we tend to see some weakness after this historically all the way to the middle to latter part of March. Even though we're in the month of February, we're in the 6-month window when stocks tend to do the best. February is the worst of those 6 months, even during an election year. We'll be in Tuesday's session, which in 2023 tended to be down more than up. And then looking at the 13th trading day of the month, where we do see a little bit of positive seasonality when looking at the green dashed line, that's during an election year for the S&P. And Tom Bowley has his research, and we're coming more into the part based on what he's found, where the latter part of February tends to be pretty negative. Then this is Don Bird's chart, where we're coming now. I have to find it way over here on the left. We're coming up into the latter part of February where we do see some seasonal weakness that could take us into the middle part of March. But then on the positive side, and then I've been showing this chart for quite a while, when we were finishing out 2023, there was a parallel between what was happening in 1982. And so we're wondering, okay, in 1982, things got really good after that. We're wondering, are things going to play out in a similar fashion this time? I don't make decisions based on this. I find them interesting, just kind of use them as guides and then just see, okay, it ends up being kind of like that, or no, we're deviating away from that. Then looking at the statistics from 1950 to 2023, the S&P is up a little bit more than down in the month of February, but we do end up having a negative return on the month. And then this is kind of crazy spacing here. We're not really going with the down one right now. We don't want to front run this. The market still may have some upside potential, and we're near all-time highs, and that's not a negative thing. And we're not necessarily seeing a blow off top, at least to this point. But we want to respect the idea that we could be seeing some kind of a pullback and that we are coming into a period of seasonal weakness, but we're not seeing a confirmation of that yet in our charts. Okay. The one area that we're not going with right now is the sideways trend, because even though the ADX is below its moving averages, suggesting that the trend is weakening, we're still above 20, suggesting that we are in a trending environment, and the green lines are on top, so that trend is positive. Then the warning signs. This is one thing to be aware of, that as we've been going up recently, volume has been decreasing. The risk on posture chart has not been helping us. The equity put call ratio is now starting to go back up, and that could be negative. Our oscillators are extreme positive, and they're starting to drop below their moving averages, and they're starting to show some negative divergences there. And we're also seeing some negative divergences when we look at the McClellan oscillators and the summation indexes. The parabolic SAR is negative. The Copic curve is negative. The bullish percent index for the NASDAQ 100, it's above 70. That's positive, but above 70 is an extreme positive reading. And we're still seeing more negative momentum when we look at the NASDAQ 100 as measured by the PPO. Small and mid caps, when you look at just their indexes, they're still negatively diverging from the S&P. The discretionary sector is still diverging from the S&P, but it has been improving lately. The transports are still negatively diverging, not only from the Dow, but from the S&P, and we're possibly entering a season of weak historical seasonality. Long-term signs, we're still above those longer-term weekly charts there, and as long as we stay above that, that is still positive for now. If we drop below them, that's when we're going to be a little bit more concerned. The 1 to 3 month short-term bond spread continues to be positive. We're still above where we were back in 2007, and we're starting to go back up again with the 3-month yield. And then earnings season can be either positive or negative, depending on what you're looking at, what stock is reporting. And then the positive signs are growth is holding up so far for right now, not only for the S&P, but we're seeing a real improvement with the small caps and the mid caps. And another thing is that we're extreme positive with the S&P 500 oscillators. Now, they are showing some negative divergences and they are dropping below their moving averages, but they're still giving us very positive readings. The vortex is positive, small and mid cap growth is positive and continues to hold up for right now. And the financial sector is positive. Longer term, we have the daily special K chart, which is positive. As I showed you earlier, the weekly special K chart is negative. Our longer term equity put call ratio it's chopping around. It's bouncing around all over the place. And not quite sure I didn't know where to put it. It's kind of in between right now. The Zohorchak method is still positive, and we're still working off of longer term uptrends with the Russell, the small caps, and the mid caps. And our new high, new low study is still positive. Our other NYSE new high, new low study is also positive. The cumulative new highs, new lows for the NASDAQ is turning back up and showing some improvement there. And we've seen two ZWAG and NYSE breadth thrust signals that were generated over the last year. And seasonally, this is kind of, you could take it positive because we're in the 6-month window, but February tends to be the worst of the best 6 months. And then and then the longer term seasonality is still back there as well. So our conclusion, just for Tuesday's session, we're slightly overbought, but we remain positive. We're watching to see some signs of weak seasonality. That's what we're watching in the short term, and then we'll see if that develops more into the intermediate term. We're still positive in the long term, even though we are overbought. We have a 150 and a 200 period moving average study that are back to looking extreme positive. Thank you. I really hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.